Today, quantitative tightening comes to town. Hello again, it's Martin North from Digital Finance Analytics. Well, this post covering finance and prop news with a distinctively Australian flavour. Well, the RBA Assistant Governor of Financial Markets, Christopher Kent, made a speech yesterday titled From QE to QT, the next phase in the Reserve Bank's bond purchase programme. In May, the RBA board began to remove some of its extraordinary monetary policy stimulus that was put in place to help support the economy through the pandemic. The focus of most observers at that time was on the 25 basis point increase in the cash rate and also the rate paid on exchange settlement balances. But at the same time, the bank also decided to proceed with quantitative tightening by allowing its bond holdings to mature in a steady and predictable way over time. The bond purchase programme was adopted in late 2020 to provide additional support to the Australian economy at the same time that the cash rate was reduced to its effective lower bound. The bond purchases helped to reduce yields further out along the curve and contributed to a lower value of the Australian dollar than otherwise would be the case. As the bank now takes steps to remove the considerable monetary stimulus, increases in the cash rate are the tried and tested measure that will do most of the work, including because they can be easily calibrated to evolving economic conditions. The end of the term funding facility and the gradual process of quantitative tightening, though, will also play a role in the task, even if it's a modest one. Because the bank's bond portfolio will mature gradually, the bank's balance sheet and commercial banks' ES balances will remain large for some years. This means that the cash rate will continue to trade significantly below the cash rate target, but above the rate paid on exchange settlement balances. And most importantly, though, the bank will continue to be able to maintain effective control over the cash rate as it withdraws monetary policy stimulus in the period ahead. Well, that was RBA speak. So what does it all mean? Well, John Kehoe in the AFR observed that the Australian dollar will no longer be pushed down by the Reserve Bank of Australia as the central bank unwinds its $280 billion government bond buying program. Christopher Kent said on Monday that the purchase of federal and state bonds during the pandemic had lowered long-term government borrowing costs by around 0.3 percentage points and had contributed to a lower exchange rate. But the RBA is gradually allowing the bonds to roll off its $600 billion balance sheet over the next decade as the bonds mature and governments refinance the borrowing in debt markets. By allowing our bond holdings to gradually diminish over time as they mature, the initial stimulatory effects of those holdings, namely downward pressure on government bond yields and the Australian dollar exchange rate, will gradually unwind, Dr. Kent said on Monday. The currency is influenced by a range of factors, including commodity prices, inflation, interest rates, and the actions of foreign central banks. The RBA embarked on the unconventional bond buying program in 2020 to reduce government borrowing costs and to negate upward pressure on the Australian dollar from foreign central banks buying their country's bonds. The RBA acquired $224 billion of federal government bonds and $57 billion of state government debt from financial institutions in the secondary market between November 2020 and February 2022. The bank's share of federal debt on issue jumped to 35%, similar to the US Federal Reserve, but below other central banks in Canada and New Zealand. The 10-year government borrowing rate dropped below 1% in 2020, but the subsequent spike in inflation has pushed the yield above 3%. Dr. Kent said it was possible quantitative easing could be used in a future economic downturn. And by the way, the bank is undertaking an internal review of the unconventional tools it used during the pandemic, including the related 3-year yield curve target that it was forced to abandon after markets bet against the RBA. The RBA currently has no plans to actively sell bonds from its portfolio, and will instead allow them to gradually expire through a passive quantitative tightening strategy, Dr. Kent said, and said the RBA would increase the cash rate to actively tighten monetary policy, following on from its 0.25% of a percentage point increase to 0.35% this month. First, the board judged that raising the cash rate was the best way of reducing the extent of monetary stimulus in the economy, Dr. Kent said. In particular, it's easier to adjust policy and influence financial conditions by calibrating one instrument rather than two in response to evolving conditions. Second, sale of bonds by the bank into the market could potentially complicate the task of issuance by the federal, state and territory authorities, including by adding to volatility in bond markets. And third, should a bond buying program be needed in the future to provide support to the economy, it would be likely to be more effective if sales are avoided this time around. That's because the effect of those purchases on bond yields and the exchange rate would arguably be lessened if the market anticipates a fast rundown of holdings next time around. So about $2 billion of bonds will roll off in July and a further $2 billion in November. The quantitative tightening will become larger from next year, including about $13 billion in April 2023, and by April 2024, about $47 billion of bonds purchased in support of the yield target and market functioning will have matured. The RBA's balance sheet has tripled to more than $600 billion during the pandemic and is expected to remain much larger than pre-COVID-19 levels, even after the $188 billion term funding facility for commercial banks expires. But the thing I want to highlight here is that this will put upward pressure on new funding by both the banks and also state and federal governments. In other words, they're going to have to pay more in terms of the interest that they pay on debt than they've been used to. Now, that could have a very interesting effect, forcing the banks to put their mortgage rates higher than otherwise. And of course, the cost of funds being higher by both state and federal entities means they've got to pay more in terms of interest, which means there's less that they can actually spend on doing other things. So implicitly, we're into a significant tightening round where interest rates will go higher. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.